Listen, this protects money, not feelings. I'm going to say something that will irritate people who enjoy being busy with their finances. If you are still treating money like a lifestyle tool first and a capital tool second, you will never get rich. I've seen the same failure pattern across multiple market cycles, and it always ends the same way: comfortable today, exposed tomorrow. Most people don't have a money problem. They have a behavior problem, and behavior is the only thing you can't outsource. You can outsource taxes, you can outsource portfolio execution, you can outsource bookkeeping, but you cannot outsource discipline. If you try, you'll simply pay fees to stay undisciplined. The thing I'm talking about is simple: spending like your income is permanent, investing like your liquidity is infinite, and managing risk like markets are obligated to cooperate. That combination guarantees you will never build real wealth, because real wealth is not the ability to consume. Real wealth is the ability to stay solvent and keep compounding when conditions turn against you. Most people never get there, not because they didn't earn enough, because they never built a system that prevents them from self-sabotage. Now I'm going to lay out the rule set I use and the behaviors I refuse, because they destroy compounding. Quietly at first, and then all at once. Most investors misunderstand wealth because they believe wealth is a number. It's not. Wealth is a structure that does three things. It keeps you liquid when other people are forced. It keeps you cash flow positive when the economy tightens. And it keeps you emotionally stable when the market becomes irrational. That structure is what separates a wealthy investor from a high-income spender. High-income spenders look wealthy until the cycle breaks. Wealthy investors look boring until the cycle breaks. Then the difference becomes obvious. Here's the popular belief I'm challenging, calmly and directly. People think earning more is the solution. It helps, but it's not the solution. I've met people with high incomes and no wealth. I've met people with moderate incomes and serious balance sheets. The difference was never intelligence. It was always rules. Rules that don't care how you feel. Rules that don't change because you had a good month. Rules that prevent you from confusing comfort with security. And here's the harder truth. Most people aren't investing. They're consuming with a portfolio attached. They invest whatever is left over after life takes what it wants. That approach never creates wealth, because wealth requires priority. You fund compounding first, and you let lifestyle live inside what remains. If you reverse it, you can still look successful, but you will not become financially independent. Now let me establish something about credibility, because I'm not speaking from theory. I've watched markets reward complacency and punish prudence until the exact moment they reverse, and then they punish complacency brutally. I've watched the same behavioral cycle repeat. A long stretch of stability convinces people that stability is normal. Then leverage rises. Then spending rises. Then risk tolerance rises. Not because people got smarter, but because they got comfortable. And when the environment shifts, rates rise, liquidity tightens, earnings disappoint, those same people discover that their plan was just a set of assumptions. I don't build around assumptions. I build around what can survive being wrong. That is what wealth is: survivability plus compounding. So here's the core framework. This is the rule set. And I want you to listen carefully because it's not complex. It's just unpopular. Rule 1. Income is not wealth. Cash flow is not wealth. Assets are wealth. If you stop working tomorrow and you stop earning tomorrow, what continues paying you? If the answer is nothing meaningful, then you are not wealthy. You are employed. Employment can be excellent, but don't confuse it with wealth. Rule 2. Lifestyle must be capped by a formula, not by mood. If your spending expands automatically when your income expands, you will never create a surplus large enough to compound aggressively. You will always feel almost there. Almost there is a lifelong trap. Rule 3. Every dollar must have a job before it enters your account, not after, before. If money arrives unassigned, it will be claimed by friction, impulses, and convenience. That is how people with strong earnings end up with weak balance sheets. Rule 4. Liquidity is not optional. Liquidity is not cash sitting idle. Liquidity is the ability to act when other people cannot. In market turns, liquidity becomes a weapon. In stable markets, liquidity looks like prudence. In unstable markets, liquidity looks like power. Rule 5. Risk must be priced, or it must be avoided. You do not take risk because you feel confident. You take risk because you are being paid. And paid means you can identify the return driver and you can tolerate the downside without forced selling. Now we go into the main body. This is where I'm going to be very specific about the behavior that prevents people from getting rich. If you're still doing this with money, you'll never get rich. You're using your future to fund your present, sometimes directly through debt, sometimes indirectly through lifestyle inflation, sometimes through a portfolio that is structured like a casino, high volatility, low resilience, and no cash flow base. It all leads to the same place. You cannot compound because you cannot stay invested through adversity. Compounding requires time and continuity requires stability. Let's break down the specific behaviors step by step, like an adult managing capital. First behavior, treating recurring expenses as harmless because they're manageable. This is how people slowly lock themselves into permanent obligations. A new car payment that isn't a big deal. A larger home payment because rates will eventually come down. Subscriptions that are individually small but collectively significant. Private school, expensive travel, premium everything, because you deserve it after working hard. I'm not moralizing, I'm analyzing. Recurring expenses are not expenses. They are claims on your future cash flow. And the more claims you create, the less capital you have to buy assets. That's the entire game. Wealth is not built by what you buy. It is built by what you refuse to normalize. Second behavior, funding lifestyle with leverage while pretending it's strategy. Leverage is not inherently bad. Leverage used for productive assets with conservative terms can be rational. Leverage used to consume is financial decay. If you borrow to buy things that depreciate, you are trading future optionality for present comfort. That's fine if you accept the outcome. But you do not get to do that and then act surprised when you never build wealth. Because wealth is optionality, and you sold it. Third behavior, investing without a cash flow base. This is where intelligent professionals make a very expensive mistake. They allocate into high beta assets, long duration growth, thematic ideas, speculative positions, because the upside looks attractive. But they do it without a stabilizing layer of assets that pay them while they wait. So when volatility hits, their portfolio becomes emotionally unmanageable. They start watching prices. They start reacting. They start reducing risk at the worst possible time, which is another way of saying they sell low. This is why I prioritize a barbell structure, a cash flow, resilient core that can survive tightening conditions, and a measured sleeve of risk assets for upside. Not because I'm cautious by personality, because I've seen what happens when liquidity disappears. The market doesn't care that you had a good thesis. It cares whether you can endure the path. Fourth behavior, confusing diversification with a pile of unrelated positions. Owning many things is not diversification. Diversification is owning exposures that behave differently in different regimes. If your entire portfolio is different versions of the same bet, cheap money, rising multiples, perpetual growth, then you're not diversified. You're concentrated. And concentration is fine if you can be wrong without being forced. Most people can't. If you're holding 5 or 10 high correlation assets, you've built a portfolio that fails all at once. And when it fails when liquidity is worst. Fifth behavior, letting taxes, fees, and frictions silently eat your compounding. This is where people lose wealth without noticing. High turnover, short-term gains, constant improvements, chasing performance, paying spreads, paying advisory fees for activity rather than results. Your returns are not what the market gives you. Your returns are what you keep. If you are still ignoring tax efficiency and turnover, you are donating compounding to the system, and the system is very happy to accept it. Sixth behavior, treating emergency reserves as unnecessary because your income is stable. Income stability is not a guarantee. It's a period. Markets change, industries change, health changes, policy changes. The difference between an investor who gets rich and one who doesn't is not the ability to predict those changes. It's the ability to absorb them without liquidating long-term assets. Emergency liquidity is what prevents forced selling. Forced selling is the single most reliable way to destroy compounding. Seventh behavior, believing that real estate always goes up or stocks always go up is a plan. Those statements can be broadly true over long windows, but people don't live in long windows. They live in sequences. If your sequence includes a job disruption, a refinance at higher rates, a market drawdown, and a liquidity squeeze at the same time, the long-term chart does not help you. Sequence risk is what ruins people who were right over 30 years, but wrong at the wrong moment. Wealth is built by managing sequence risk, not by repeating slogans. Eighth behavior, outsourcing thinking to headlines. If you're still making money decisions based on what the media is emphasizing this week, you're operating on a manipulated input. Media is not designed to make you wealthy. It's designed to keep you watching. I don't care what the consensus says. I care what capital is doing. I care what credit spreads are doing. I care what refinancing terms are doing. I care what profit margins are doing. I care what the labor market is doing at the margin, not in the headline number, because the margin is where turns begin. This is where I speak to you directly because it matters. If you're still increasing lifestyle expenses in the same year you're increasing portfolio risk, you need to understand what you're doing. You're doubling exposure. You're increasing fixed obligations while increasing volatility. That is not confidence. That is fragility. The wealthy investor does the opposite. They keep lifestyle relatively stable, and they scale risk only when they are being paid. They maintain liquidity so they can buy when other people are forced to sell. They don't need to feel rich today. They need to become unbreakable. Now let's talk about the practical application. How do I run money so I don't fall into these traps? I operate with 3 buckets, and they each have a purpose. Bucket 1, liquidity and defense. Short duration, high quality instruments that preserve optionality and pay me something while I wait. This bucket exists so I can act when prices become irrational. It exists so I never have to sell long-term assets to fund short-term obligations. Bucket 2, cash flow compounding. Quality businesses and assets with durable demand, strong balance sheets, and shareholder returns. Not because they're exciting, because they let me stay invested through uncertainty. They reduce the emotional load of volatility. Bucket 3, measured upside. A controlled allocation to higher volatility opportunities where the upside is meaningful and the downside is survivable. This bucket is where you express views, but it must never become the portfolio's life support. If you invert that structure, if your upside bucket becomes your survival bucket, you're gambling. And gambling eventually finds the cycle where it stops working. Now we neutralize the objections, because people always resist rules that remove comfort. Objection 1. You only live once. Spending is part of life. Correct. And that has nothing to do with what I'm saying. I'm not advocating deprivation. I'm advocating control. If you want to spend aggressively, do it from surplus that does not compromise your compounding. If your spending requires optimistic market returns to remain sustainable, then your lifestyle is leveraged. Leveraged lifestyles break during market turns. Objection 2. Debt is smart. Wealthy people use debt. Wealthy people use debt against productive assets with predictable cash flow, conservative structures, and favorable terms. They do not use debt to inflate consumption. They do not use debt to avoid discipline. If you're borrowing without a clear return driver that exceeds the cost and risk, it's not sophistication. It's impatience. Objection 3. I can't get rich slowly. That statement is usually an emotional negotiation with reality. The market does not offer consistent, fast paths to durable wealth without corresponding risk. If you want to become wealthy, you need compounding and survival. Survival is not fast. It is simply necessary. Now, the forward-looking warning, because this is where the cycle is heading for many people. If you keep treating money as a lifestyle amplifier rather than a capital tool, the next tightening phase will expose you. If rates stay higher for longer, your fixed obligations become heavier. If the economy softens, your income becomes less certain. If markets draw down, your portfolio becomes emotionally harder to hold. Those 3 things together create forced selling. Forced selling is the event horizon. Once you cross it, the math turns against you. And when the market eventually turns upward again, the people who were forced out will not participate in the recovery. Not because they were wrong, because they were structured to fail. That is the quiet tragedy of blind financial behavior. It's not a lack of intelligence, it's a lack of design. Here's the insight I'll leave you with. Getting rich is not about the next opportunity. It's about eliminating the behaviors that prevent compounding from working. If you remove lifestyle leverage, control recurring obligations, maintain liquidity, and invest with a cash flow core, you don't need perfect timing. You need continuity. Continuity is what turns years into wealth. Now, if you want continued clarity, cold, calm, and focused on preserving and compounding capital, subscribe, not as entertainment, as a filter. And watch the next analysis, because I'm going to break down the most common, normal portfolio positions that look reasonable in good times and become disastrous when liquidity tightens and credit conditions turn. That's where most money is lost. And that's where disciplined investors quietly get paid.